Every D2C brand has access to Shopify Capital. The reality is there are only some things you should use debt to finance. R&D and ad spend can be risky to finance with debt. Is the debt that you're considering taking, is it causing you to go bigger than you would otherwise? All right, Dylan, we're back. What's happening, man?
We're talking about leverage today, John. It's a pretty serious discussion. It is no laughing matter.
It could be the ultimate scaling fuel or the ultimate risk. Yeah, we're kind of playing a game today. That's what we're doing. We're playing a game. We're playing a game called Should You Finance This? This might be my calling, game show host. I'm not exactly sure.
Should you finance your lunch at Chipotle? That may be an option now. So I don't know.
Consumer debt is I don't know. Yeah, man. So that's what we're talking about today. I'm excited. I'm pumped up. We just got off of a live recording of the first Ecom Scaling Show live, which was tons of fun. So like I'm pumped to chat some more. And well, actually, before I ask you the first question, I want to explain why this topic is near and dear to my heart, because in today's age, especially in ecom, debt availability is like, it's so pervasive. It's so easy. Every D2C brand has access to Shopify Capital. I think like close to 100% of them have the ability to draw on that really quickly, really easily, just a few minutes of an application. So debt is at your fingertips. It's alluring. Growth capital. Non-dilutive growth capital. That's what they all love to say, right? Sounds great. But the reality is there are only some things you should use debt to finance. And today we're going to help you decide what things you can use debt for and which things you shouldn't use debt for. So to start, my big question to you, Dylan, ad spend. Should ad spend be financed with debt?
Generally, no. John's like, oh no, what is he going to say here? I don't think
generally, but the exception is
well, like technically, if you have a credit line with Meta, are you financing like you are borrowing the money to spend to pay with your net terms or whatever. So like, if you have like a credit line with your ad platform and you pay it on time, so there's no interest, or sometimes at some amounts of scale it's possible to play some games where you basically use credit cards mixed with the line to effectively have near 0% interest. Like maybe, but by and large, you probably should not be financing your ad spend. And the reason why is because your ad spend should be profitable. That should actually be like a line item you do not want to like make very risky bets on. Having said that, you can sort of make an argument sometimes as well for like super high LTV businesses, because at that point, are you using the debt to fund ad spend, or is it something else? At the end of the day, you just have like some cash requirements that you have to outlay. There's maybe some times where if you have really strong lifetime value, you can temporarily fund your CAC with a little bit of debt. But I would be like incredibly cautious using debt to fund ad spend. I am not a fan of using it to fund ad spend. I think at least the traditional forms of debt that we all kind of are used to thinking about, I do not think that it is often going to be a good risk-adjusted return, with a few exceptions. What do you think?
Yeah, well, you brought up several great points. There's a couple things I guess I'll add to or elaborate on. The first one is like, as a general rule, it's safer to use debt if there's predictability in whatever it is that you're using it for, right? And so I think using debt to fund ad spend on an unknown product launch, right? Or a product launch with an unknown outcome, right? Versus using debt to scale, some sort of a product that's got some fairly tried and true performance, less risky. Still, there's risk inherent in it. And so I think that's a big thing that you need to account for. And then I would say, I think there's a difference between what I'll call float and like really debt, like using credit cards to float 30 days, right? For like a credit card statement period, your ad spend, or like you said, getting meta terms. I consider those more what we in the finance world call trade payables involved in just the trade of doing business, right? That's less risky, but why? I think it's a behavioral thing. Actually, it's like a human behavioral thing. When you take debt and you do a drawdown and a wire comes into your bank account and all of a sudden your cash balance goes up, it's like, whoa, I got money. Like I got money to spend, right? Whereas like when you're talking about financing your ad spend or floating your ad spend with Meta like 30-day terms or with a credit card, there's not this cash influx into your bank account from drawing down on a loan. And so I think there's more discipline behaviorally involved in leveraging trade payables. So those are the couple things that I'll say. The next one is new product development and/or / R&D. Dylan, should you finance this with debt?
Probably not. So like if you are the way to think about it is this. There's a few things that you have on our list today that I think are like maybe not something that a brand owner has to think about every single day or every single week.
Yeah.
But in general, in my opinion, the most common use of debt in an e-com business is to buy inventory. And you should probably only use debt to buy inventory that you have a high conviction in, that you're going to be able to turn positive contribution margin dollars using that debt. If I had to put it into like one line of when to use debt, it's like if it fits that, then it's probably a good use of debt. Obviously, there's always risks, but I would say that for new products, you don't know if it can drive positive contribution margin. Now, if you are doing like a relatively low MOQ and you have a ton of active customers and it's like a similar or adjacent product, you might be able to justify that, like, yeah, there's a really high chance we're going to move through these units, but make sure it's a really low MOQ if you're going to use debt to finance it. And oftentimes the businesses that are big enough to actually like have an active customer file where they can just confidently launch products with a low MOQ and know they're going to basically move through them all, they're maybe not the businesses that need debt or have as much debt. Maybe they're at a more mature, established place in their business and they don't need that kind of capital for that type of a move. But I would say that especially if you're doing like heavy R&D into a product, or something, or making a big bet on a new line, you don't have the data that to support that you can actually confidently turn positive contribution margin dollars. So I would be very hesitant to overextend myself with credit in this situation.
Interesting. I agree generally, but there's a couple of things I want to add. Like R&D has this uncertain return and payback period, right? And that's why so many R&D heavy businesses, SaaS is like a common example. Lots of R&D, right, to get SaaS off the ground and make it profitable. Big R&D heavy businesses tend to do big equity raises up front. Why? Because they need the capital to extend their... Why does runway matter? Runway matters because what you're basically doing is you're trying to give yourself a certain amount of time to figure out through R&D how to make something viable, right? There's no guarantee. You're trying to figure it out. You're placing that bet. And so generally speaking, heavy R&D should be financed with equity. Why? Besides the payback and the unknown ROI, there's also this concept of collateral versus no collateral, right? It's like if you buy a hard asset with inventory, there's still risk that the decision you make is not profitable net of the debt cost, right? That's always a risk. Could also not be cash flow positive net of the debt service payments. But if everything goes to hell in a handbasket and you have to default, you can hand the physical asset back to the bank, right? So you can actually hand them something. It's not the cash, but if they're able to go liquidate that and make themselves whole, then you're off the hook at that point. And so I know I bring up real estate a lot, but it's a good example to think about. It is risky to use debt to buy real estate, but if you're buying it, if you put enough money down on the loan, even if you default on it, there should be a big enough gap between what that real estate's worth and what you owe in debt that if you walk away and hand it back to the bank, they should be able to sell it at a discount, make themselves whole, and then you're off the hook. And so that's another reason why R&D and ad spend can be risky to finance with debt, because if you go belly up or you default and you can't pay the loan back, you can't hand them your ad spend and your R&D and they liquidate it to pay off their loan. So collateral versus no collateral, I think, is important as a mechanism for helping offset some of the risk in a worst case scenario. So
100%. I totally agree. And simply put, it's like how liquid is this? Like real estate is cash, but there is generally like sufficient demand in most markets where at least even at some discount you can move an asset like that in some reasonable amount of time. If you're a brand new brand and you have like a half finished product, there's not much utility there from a liquidity standpoint. Whereas if you're an established business and you have a well-known brand, chances are they may be able to move it with a little bit less pain. It's like, how fast can I liquidate this asset if I have to take possession of it? I think that makes complete sense. From your perspective, what about CapEx? Can you when does it make sense to use debt there versus something like equity?
So CapEx, in terms of purchasing physical capital, equipment or machinery or something that's a hard good, this generally can be a good candidate for the use of debt. Now, there's a couple best practices you need to keep in mind. One, this is consistent with like you have collateral that you can give the bank back if you can't pay the loan, and they can hopefully liquidate it and make themselves whole, right? So that reduces risk. It also increases the likelihood. It's easier to get a loan for capital equipment than you think. It's actually, you don't even have to have like the greatest financial history, because the collateralization of the actual physical asset itself, which is another advantage. But what I will say is that you need to think through how that capital expenditure is going to generate incremental cash flows over time that will service the debt. So let me give you probably an easy or like a simple to understand kind of example. So back in the day, earlier in my career, when I worked as the head of finance for a factory, we would do these analyses all the time on buying another CNC machine, right? And when we started hitting capacity constraints where like we couldn't keep up with the output that was needed to feed our sales orders, the orders that we were getting, you could start to quantify how much money we were losing every single hour by not bringing another machine online, right? And so you could do some rough math to go, if I spend $100,000 on buying a new machine that can output this much, you could start to calculate by hour or by day and ultimately by month how much incremental profit we'd be able to generate by having that particular machine in service. And then you could go match that up against the debt payment, right? To see, does this pay for itself? Does it service the debt itself? That's the best case scenario. Sometimes it only partially services the debt, but the key is if you can figure out the incremental benefit to the company's profit and cash flow and the time period over which that machine will pay for itself, and it can service the debt with that incremental benefit, then it can be a win-win-win all the way around. And if it doesn't, if you don't see like if you don't like the answers to any one of those kind of like three areas, then you might have to rethink this decision. I'm curious. Another one that I hear a lot is hiring. Like I actually had someone not that long ago that I was talking to say, hey, like
a crazy statement to me, by the way.
Yeah, no, I mean, I think it's fairly scary to think about like using, I mean, I don't know. I mean, obviously I want to hear your take in more detail, but hiring, it's kind of like R&D, right? Like I'm going to invest in human capital that is not collateral. Like you can't give that human over to the bank, right? To liquidate their value to offset the loan. There's an unknown return on the investment in that person. But like using debt to hire, I think is risky business, but I'm curious to get your take.
Yeah, I think that's like a crazy strategy. like the thing that I've learned over time is I think that I am relatively conservative with some of my like uh decisions or recommendations sometimes, and there's pros and cons, and everyone has like different risk tolerances for certain decisions. I've seen some like crazy risky things actually pay off. So like sometimes my initial reaction, oh my god, that's crazy, I would never do that. Listen, this is the thing. Most of the time, maybe that's true. There might be some like person who is able to pull something off, take an obscene amount of risk, and it all works out. But,
But
but like being like, I'm gonna build out a team. I have like no cash. I have like a negative equity balance, and I'm gonna go and like, because that's probably what you're doing here if you're gonna go and borrow money to bring on team members. Like,
mm,
I just think that like that's a level of risk, and it's not even like a. If I was going to take that level of risk, I'd rather do it on like product or something, like, because the payoff of a person is usually a byproduct of the leverage they can create in your organization, which is usually a byproduct of the effectiveness of your product. Whether you're a service provider, an ecom business, a software company. I know we're talking about ecom here, but like the best team in the world was going to have a hard time selling rocks. You know what I mean?
yeah.
Like it's rare that that is like a thing that you would do if you like, if you're the business that needs to use debt to hire someone. I just like, I don't think that makes any sense. Am I wrong?
No. I mean, again, it violates like one, the ability to use that investment to match the income from it to service the debt. It violates the collateral kind of protection that you can hand the physical asset back to the bank to liquidate to try to offset some of your obligation. And it violates like a known or like having confidence in the ROI or the
Yeah.
payback. And so like it's risky on all three of those fronts.
Yeah, I completely agree. I'm super interested in this last one because I don't, in the marketing world, I don't come across this as much, but equity buyouts. Are you talking more about like dividend recaps, or are you talking about like buying out other equity partners, or both? Like,
Yeah,
and,
or even buying new businesses. Like I think
yeah,
at
yeah.
purchasing. Okay, let me be clear. Let's take this. It's not just, hey, you should use debt to finance equity buyouts. You shouldn't use debt to finance equity buyouts if the business is not cash flow positive, right? Or the equity position is not profitable, unless you have cash reserves to
Yeah, to service
offset the
the debt.
losses and service the debt, right?
Yeah,
But
it's like any sort of, it's essentially like the same like order of operations you would go down of if an LBO, a leverage buyout, makes sense. Like,
totally.
can how durable is the cash flows? Can it service the debt? All that stuff.
Yeah, exactly. So like I think this is just one that people forget about a lot. I think longer duration term loans, fully amortized term loans, which mean you make the same payment every single month. Portion of it is principal, portion of it is interest. It's like a mortgage. A 30-year mortgage is a term loan. If you can get a 5, 7, or 10-year term loan at a fixed rate, right? So that locks in your payment. You know what the payment is, and you're buying an equity position in a cash flowing business, whether that's buying your partner shares or it's doing, buying out some of the other owners in the business, or you're just buying net new into a business. This can be great, but the key is that you have to underwrite the cash flows and confirm that the debt can be serviced, but that there's also sufficient working capital in the business after the debt service to make sure that you're not starving the business
And
with that debt service.
yeah, and I want to like double click into this because we talk about this a good amount, but ecom businesses, most of the time, if you're excellent and you're running a really great operation, maybe not, but most of the time, net profit and cash flow is not the same. And servicing debt as an ecom business, especially if there's a good amount of debt, is often incredibly difficult. So, like, and even if you have been good, you have to be really honest with yourself. Do I think that this is likely to continue, and how risky is this? What is the
Totally.
underlying makeup of the durability of revenue in my business? Because profit does not service debt, cash flow services debt. So I agree. I think it can definitely be a path to use. Can you finance it? Yes, you can. And sometimes it can be a great tool, but you just want to be very, very careful because not all ecom businesses are created equally, and some have way more variability than others.
Well, okay, so let's double click one more time into this. What I oftentimes see happen, I know a few people who do this or have done this very successfully with a SBA 7A loan, which is a 10-year term note, which you lock in a payment for a 10-year duration, so it's like a fixed cost that you know. But here's a couple things that they've done to make it successful, and that you need to think about if you as a listener are considering this. One, by you purchasing the business, there's some leverage on the P&L that you're able to get that the previous owners couldn't, right?
Yeah.
And so if you can offset some of the debt service monthly
Immediately.
cash outflow with that leverage point, then that's key. But here's the second thing that I think a lot of people forget about. I was helping a good buddy of mine through this a few months ago. That 10-year term loan, usually if you're working with the SBA, they want some sort of an equity injection. You have to get at least 10% equity injection on the front end. And usually they want to give you a loan that's a little bit more than the equity buyout so that there's some reserved for working capital. And this is the big point I want to dig into is you got to be careful about this with the Ecom brand, because like, let's just say that you buy a brand for $2.5 million and you get a $3 million SBA loan, and the SBA lender is willing to say like, hey, at 10% down on the loan, yeah, we'll give you $500K equity injection or a working capital. It's for general working capital. You have to project forward the growth that you're going to drive. You have to ask yourself, is $500K enough? How long will that last to finance general working capital needs? And if you continue to scale, you'll actually find that doesn't last very long. Why? Because your inventory is bouncing up and down as you're continuing to scale, depending on how much you're an LTV brand versus new customer dominant, seasonality, all those things. And so what actually works best is to get a 10-year term loan through the SBA to do the equity buyout, but then bring in another piece of financing that sits subordinated to that SBA loan that just finances inventory, because those needs are going to change over time. And it's highly unlikely you're going to sufficiently capitalize general working capital needs at the closing of that SBA loan to continue to scale the brand's working capital needs over time. So like, make sure you don't screw that up, but you got to talk to the lender up front to be like, hey, to make sure that they know that you need to bring in another piece of debt capital sooner rather than later, because there's nothing worse than getting denied by the SBA lender that like they're not going to approve a subordinated note. And you're like, well, now I'm handcuffed and I can't grow anymore.
So that makes complete sense. Any final thoughts on what best practices for when to use debt or not use debt?
Yeah, there's two things. One is you can have a general working capital line of credit that maybe funds all or some of these things at the same time, or funds different things at different times, right? So you actually can get a line of credit that you use it for ad spend for a period, or for some of your product development costs for a period, or you use it for inventory, or you use it for hiring. But what's the key is that most brands who do that well have a CFO that can manage a cash flow forecast and a 3-statement financial model. But what you do is you look at the business in aggregate in terms of the P&L and the cash flows and the cash needs, and you just kind of draw down and pay back the line as you need it. But what is your CFO doing at any point in time? They're making sure you have sufficient collateralization, that you never borrow more than the physical assets you have in the business. So if you do belly up, you can return those to the lender and hopefully make yourself whole. They're making sure that you're profitable and that you're cash flow positive, and that you're getting an ROI that is above and beyond the cost of debt. So you can actually mix these things together in practice if you have a financial professional helping you, but they still make sure that you go down that scorecard of those three things we keep looking at, and making sure in aggregate you don't violate them. So that's the first thing. The last thing is, ask yourself, is the debt that you're considering taking, is it causing you to go bigger than you would otherwise? Because that's actually the behavioral trap in all of this, right? Hey, is this access to someone else's cash causing me to emotionally decide to go bigger than I would otherwise? So it's good, if you have access to debt or not, to remove it from the table for a second and say, what's the decision I would make based on the data I have available and my risk tolerance without debt? and then bring the debt into the equation and say, do I want to use debt for part of that? Because really where people get themselves in trouble is not necessarily, it is using debt for the wrong things, but it's using debt for the wrong things paired with going bigger than they would otherwise without debt. So I think that's a big thing, a big question you ask yourself. So what are your final thoughts, Dylan?
Yeah, similar to what I said earlier, I would just say that if you're going to use debt, make sure you're using it for things where you have a high degree of confidence that it is going to be invested or spent into a line item expense that you think will actually yield additional contribution margin dollars. So I think like pre-existing inventory with lots of data for most brands, this is going to be the most common. But the other kind of, whether it be CapEx, equity buyout, some of the things you went through, Jon, sounds like that could make sense based off like a business's specific needs. And sometimes it may not, right? It's very case by case. But I'd say the simplest one for me is on the inventory side, just make sure that you have a good margin for error, and then it's likely or can be a safe solution.
Well, I think that's a wrap. This was a good one, Dylan. Appreciate your takes on the concept of where brands should and shouldn't use debt, and I think that's a wrap.
Likewise, Jon, have a good one.